Hey everybody, welcome to today's video. I am going to be going through a list of vocabulary words that you will need to know and that you probably will be tested on for your life insurance pre-license exam or your life and health insurance pre-license exam. This is essentially a giant vocabulary test with some states being more difficult than others. That's just how it is. But if you know all the words and all the vocabulary words in your course, in whatever material you're studying, and if you know all the words that they're going to test you on, then theoretically, you'll get 100% on the exam. So I'm going to be going over some vocabulary that has to do with the different riders and provisions and different options for your life and health pre-license exam. And these are vocabulary lists that I actually came up with myself to help people pass their exam on the first try. So first one we're going to get into here and just dive right into it is absolute assignment. Quick note, as you're going through your course, I highly recommend that you don't move on to another part of your course until you get down most, if not all, of the vocabulary words in that chapter of the course that you're using. Super, super important. And yes, I just had a sip of soda. Some people hate when I eat or drink on my videos, and if that's you, then I don't know. So, absolute assignment, it refers to the complete transfer of ownership rights and control over an insurance policy from the original owner to another person, known as the assignee. In situations where the policy is used as collateral for a loan, the original owner retains any rights exceeding the debt amount, even if the assignment appears to be absolute. That would be more called collateral assignment. So in all of the vocabulary lists that I've created, I attach an example, a real life example, to help paint the picture to what this word means. I found I'm a very visual learner, and most people are visual learners, so this helps people grasp these so much more. So we're going to go to the real life example here for absolute assignment. John assigns his life insurance policy to his friend Mark to secure a loan. Mark gains full control over the policy and its benefits, but John still holds rights to any value above the loan amount. So that would be more like a collateral assignment. And another example for absolute assignment could be that John assigns his life insurance policy to his friend Mark to take over the policy. So there might be an absolute assignment, a change in ownership of the policy. So the owner of a life insurance policy can assign someone else to be the owner. Next, accidental death benefit, or the multiple indemnity rider. So an accidental death benefit rider provides an extra payment to the beneficiary if the insured's death results from a covered accident. This extra payment is usually a multiple of the policy's face value, such as 2 or 3 times the original amount, offering the most cost-effective way to increase coverage temporarily. So what an accidental death benefit rider does is it increases the amount of money that the beneficiary receives if the insured dies as the result of an accident. Every insurance company has, they're usually similar, but there are rules around what is deemed death as a result of an accident. Some companies say that death has to result within 30 days of the accident and be directly tied to the accident. Some say it has to be 60 days, but basically, if the insured dies as the result of an accident, then a accidental death benefit rider will increase the benefit. So we'll look here. Example, Emily has a life insurance policy with a face value of $100,000. She adds an accidental death benefit rider that pays out double the face amount. If she dies in an accident, her beneficiaries receive $200,000. Okay. By the way, if you feel like definitions and examples will really help you retain some of this information, just click the link in the description of the video or the pinned comments to get access to all 20 of my study guides of vocab lists and cliff notes that have definitions and real life examples. You can pick up a copy of those for only $37. $99 value, selling them to my YouTube viewers exclusively for $37. It's an absolute no-brainer to get down all these words. Basically, if you learn everything in there and you get down all the words, there's no way that you're not going to pass your exam on the first try or the next try if you've already failed it. Which if you failed it, that's okay because you just know what you need to study. Next, accelerated benefits rider. So the accelerated benefits rider allows the policyholder to access a portion of the death benefit while still alive if diagnosed with a terminal illness expected to result in death within 1 to 2 years. The amount taken in advance reduces the total death benefit available to beneficiaries. Example: Maria is diagnosed with a terminal illness and has a life insurance policy with a $500,000 death benefit. She uses the accelerated death benefits rider to access $200,000 for medical expenses. When she passes away, her beneficiaries will receive the remaining $300,000. So the accelerated benefits rider is it's a very, actually, it's awesome. So it's a really good feature on life insurance policies. Usually they don't charge any extra money for it. Usually it's included in the policies, the ones that I've seen. I've seen a lot of them. And this is a way for the insured to access their death benefit before they pass. And this is a way that they help people not have to sell their policies if they get sick and get desperate for money to help with their illness. So they're saying, hey, you're going to die anyway, so let's give you some of this money up front to help you and your family deal with the cost of being really sick. Okay, accumulate interest option. So this is a dividend option. Okay, this is something that you can do with your dividends that are earned from mutual life insurance companies who offer participating policies. So it's called a PAR policy. PAR is in participating. Non-participating is non-PAR. Those are typically issued by stock companies. So mutual life insurance companies issue participating policies that give back profits as dividends. It's actually, they technically look at it as unused premiums. But the interest earned is taxable as income for the policy owner. Example: David chooses to let his dividends accumulate interest with his insurer. By the end of the year, the dividends have earned $200 in interest, which David will need to report as taxable income. So the dividends themselves are not taxable unless they exceed the cost basis, so unless it exceeds how much the person's paid into the policy, because they're looked at as a return of unused premium. So say you pay $100 a year for your policy. At the end of the year, the insurance company says, hey, we have a $5 dividend. We're going to give you $5. Instead of them saying, here's a $5 profit, they are able to kind of weave in and out of tax loopholes and say, this isn't profit. We're just giving you $5 back, and you already spent it. So that's the way that the dividends are tax deferred. But if you let the insurance company hold the dividends to accumulate interest, then that is taxed. Okay, next, assignment clause. We talked about this a little bit, but this is the part of an insurance policy that allows the transfer of rights to another party, from one owner to another. Sarah assigns her life insurance policy to her business partner as part of a buy-sell agreement. This ensures that if Sarah passes away, her business partner will receive the policy benefits to fund the purchase of Sarah's share of the business. Next, automatic premium loan provision, or rider. The automatic premium loan provision allows the insurer to cover a missed premium payment by borrowing from the policy's cash value at the end of the grace period. In other words, if you miss a payment, the insurance company can automatically borrow against your cash value to cover the premium. So this loan continues automatically until the policy owner starts making payments again, or the cash value is depleted. Oh, here, let me make this. At which point the policy will lapse. So example, Alex misses a premium payment on his life insurance policy. The insurer uses the automatic premium loan provision to borrow from Alex's cash value to cover the payment. This keeps the policy active until Alex starts paying again or the cash value runs out. So it's essentially saying like, hey, you got some cash value in here. If you miss a payment, we're going to use that to cover the premium, and it's going to be taken out as a loan against the cash value. So that's how that works. By the way, I'm getting these vocabulary lists from my own pre-license course. So this is a chapter in my life and health insurance pre-license course. I have a life insurance pre-license, life and health, This course of $490 value, you can get it for only $97. It includes the vocabulary and key terms. We have slideshow lessons. I have over 120 videos in the entire course that are better than the ones I have on YouTube here most of the time. That'll help you learn the stuff even better. And this course for $97 also includes 5 to 6 practice exams that will simulate your state's real exam. It's the absolute closest things on the market to get your actual state exam and give you that experience. The whole course itself, which includes the vocabulary list, the practice exams, and everything else, is $97. As I mentioned before, you can get the vocab list for $37, just the vocab list and the study guides, or the smaller study guides. Or if you just want the practice exams, then those are $37 too. All that can be found in the description of the video. The practice exams are kind of study tools as well, because every time you answer a question, it'll explain why it's right or wrong. And there's over 800 questions combined in those 5 or 6 practice exams that you'll get. So automatic premium loan is huge. Next, cash option. So the cash dividend option permits the policyholder to receive their dividends in cash payments. Example, after his life insurance policy generates dividends, Tom opts to receive the dividend amount directly as cash rather than investing it. So one dividend option is for the policy owner to just receive that money, just receive the dividend. So to get paid out the dividend right there. And they can just have it deposited. Okay. So next, cash surrender option. So there are non-forfeiture options too. So those dividend options have to do with what will be done with the dividends, and then there are non-forfeiture options, and that is those determine what is done with the cash value. So I want you to think of non-forfeiture options as like if you own a house and you gain equity in the house. If you sell the house, there's different things that can be done with that equity. That can be used to purchase another house or go towards the down payment of another house, or you can just cash out and then take the cash as the equity. But when you sell the house, that doesn't just disappear. That equity goes somewhere. Either you get it in cash or it goes to another property or something like that. So for life insurance, as cash value builds within the policy, there are non-forfeiture options, is what these are called. Non-forfeiture options means it cannot be forfeited. Like you can't just lose it. All right, so you can't just lose that cash value and what's in there. So cash surrender just lets the policy owner take the policy's cash value. The policy is no longer in force, no longer has insurance coverage, and the insurers can defer paying cash value for up to 6 months by law. So after holding his life insurance policy for several years, Jim decides to terminate it and chooses the cash surrender option to receive its accumulated cash value. So cash value, it's there. Jim's like, it's my money and I want it now. So they give it to him. Next, we have collateral assignment. So collateral assignment refers to the transfer of an insurance policy to a creditor. We kind of went over this before with absolute assignment, so we're going to stick to the next one. Okay, consideration clause. Consideration is a big part of life insurance contracts. The consideration clause requires a policy owner to pay a premium to secure the insurer's commitment to provide benefits. So what this means is the policy owner needs to pay part of the consideration. The policy owner's consideration involves submitting the application and paying the initial premium payment. Details about the amount and frequency of premium payments are outlined in the consideration clause. Essentially, the policy owner provides a completed application and initial payment specifying the amount and schedule of future premiums and requests consideration for insurance. So he says, hey, consider me for this policy. Example, John's life insurance policy contains a consideration clause which specifies that he must pay a monthly premium of $100 in exchange for the insurer's promise to pay the death benefit to his beneficiaries. By submitting his completed application and initial premium payment, John fulfills his part of the agreement under the consideration clause. Okay, next, dependent or other insureds. Dependent riders allow individuals, typically family members such as spouses and children, to be added to the primary policy as insureds. Example, Sarah adds a dependent rider to her life insurance policy to cover her husband and children, ensuring they are all insured under one policy. Okay, dividend options. Dependent riders. This is a way to add children and people who depend on you to your life insurance policy. Okay. Dividend options. So we've gone over a couple of these, but dividend options refer to the various choices a policy owner has for utilizing dividend payments from their insurance policy. Example, Lisa receives dividends from her whole life insurance policy and can choose to take them in cash, apply them to reduce premiums, or use them to purchase additional coverage. So in these chapters, you do learn about what the different dividend options are. So we have the entire contract provision. The entire contract provision states that the insurance policy, along with any attached riders, endorsements in the application, constitute the complete agreement or entire contract between the insured and the insurer. So, example, when reviewing his policy documents, Kevin notes that the entire contract provision ensures that no outside documents or verbal agreements can alter the terms of insurance policy. So what this is saying is that everything in here is the entire contract. You can't make something up later on that you say is part of this. Like if it's not in here, then it's not part of it. All right. I want to give you guys some study tips here too. So make sure to study in intervals. If you get to the point where you're feeling kind of tired, take 5 minutes to go back through the last few pages of studying and see what words you don't understand. Try to define them. Because a lot of times when we're studying and we get tired, it's actually because we skipped past a word that we don't understand. And then break it up, right? Like take little breaks here and there throughout your studying. Just be consistent with it. I know some of you guys might hear people who say they passed in 3 days or 2 days or 4 days or whatever. Look, that doesn't have to be you. Just because they did doesn't mean that you have to. It's okay to take your time. You have the rest of your life to build a career in insurance. Make sure that you study and do it right, and don't just try to rush and fail and get discouraged. If you feel like you can go through it fast, awesome. No problem at all. Some states are harder than others, okay? So I found the pass rates for like Texas and South Carolina are really, really high. They seem to have a little bit more simple of exams. Minnesota, Kentucky, Alabama, North Carolina, California are just some states that seem to be a lot more challenging for people. Their questions are harder. They just ask tougher questions. That's just how it is. So if you hear that someone passed, don't compare yourself to them. Okay, and I know some of your some companies who hire you might say, "Oh, well, you got 5 days to pass this test or something." Watch the videos that I have. Make sure you get the vocab down. Take the practice exams, and you should be pretty prepared. Remember, you don't have to know everything. You just have to pass. Okay. So you can also look up your state's exam outline online and find what's going to be tested on that way. So next, we're moving on to exclusions. So exclusions are specific conditions or circumstances outlined in an insurance policy that are not covered by the policy. So it's typically WASH is the acronym. So war, aviation, suicide, and dangerous hobbies or habits. Maria's life insurance policy includes an exclusion for death caused by participating in dangerous activities like skydiving. If Maria dies while skydiving, her beneficiaries would not receive the death benefit because the policy specifically excludes this risk from coverage. Okay, extended term option. With the extended term non-forfeiture option, this is another non-forfeiture option, the policy owner can apply the policy's cash value to obtain level term insurance coverage for a set duration with no future premium payments required. The coverage amount is equivalent to the net death benefit of the original policy. Example, when Paul can no longer afford to pay the premiums on his whole life insurance policy, he chooses the extended term option. The insurer uses the policy's accumulated cash value to purchase a term life insurance policy with the same death benefit, but coverage will only last for a specified number of years, depending on the cash value. This allows Paul to maintain coverage for a limited time without continuing premium payments. So what this does is Paul can say, hey, I don't want to pay on this anymore, and I want to use the cash value that I have to just have a term policy that is the same face amount, but lasts for however long the term policy will purchase insurance for. Okay. Free look period. The free look period gives the policy owner a set number of days after the policy is delivered to examine it and return it for a complete refund of premiums. Okay. Example. After purchasing a life insurance policy, Jane has a 10-day free look period during which she can return the policy for a full refund if she is not satisfied with the terms. Okay, so a free look period is where they can get the money back for the policy for their first premium payment if they decide they don't want it anymore. Okay, so it's just a way for them to get out of it, essentially. Okay. All right. Next, grace period. The grace period is the time allowed after the premium due date during which the policy stays active without any penalties. If the insured passes away during the grace period without paying the annual premium, all right, my dog just spazzed out there. I had to pause the recording, so I'm back. So grace period, basically the grace period means that if someone misses a payment, they have 30 days to make that payment again before the policy lapses. So if the policy lapses after the grace period, then the insurance company might allow them to continue the coverage if they sometimes they have to go through underwriting again to prove evidence of insurability. So they'll say, okay, we will let you continue this policy, but you have to go through underwriting again so we can make sure that you're still healthy enough to insure you. So bottom line, make your payments within the grace period. All right, next is a rider here, guaranteed insurability rider, the future increase option. The guaranteed insurability rider lets the policyholder add more permanent life insurance at specified times without having to prove insurability. It also covers life events such as marriage or birth of a child without requiring additional proof. Generally, this benefit can be used every 3 years, allowing for increases in coverage up to the initial policy amount. So example, Lisa's life insurance policy includes a guaranteed insurability rider. When she has her first child, she exercises the option to increase her coverage without having to undergo a medical exam or prove insurability. A few years later, she uses the rider again to add more coverage when she gets married, ensuring her family has additional financial protection as her life circumstances change. So the guaranteed insurability rider, it lets the policyholder add more coverage to their whole life policy at either specified times or specific events. So having a kid, getting married, every 5 years, whatever. There's different ways that they can exercise the option, different parameters based on what they choose to elect within that rider. Okay, stop it. No one's there. Sorry, my dog's barking at nothing. Incontestable provision, or the incontestable period. The incontestable provision or period states that after a life insurance policy has been active for a certain period, usually 2 years, the insurer cannot dispute its validity. Case law has established that the incontestable clause also applies in instances of fraud. Example, after Dan's life insurance policy has been enforced for 2 years, the insurer cannot challenge the policy's validity or deny claims based on misstatements or omissions in the application. So it's saying that every state's a little different. Sometimes, with fraud, they can challenge it if there's fraud involved. But it's saying after 2 years, the insurance company cannot dispute the claim. So that means if someone dies of suicide or something else, that they can't dispute the claim. So before that, they can contest the claim. And because if someone gets approved, they shouldn't die within the first 2 years anyway. No life insurance company would approve somebody if they think they're going to die within the first 2 years. So if they do die, they say, okay, well, we'll pay the claim. We're just going to contest it first to make sure that nothing fishy was going on. And at that point, what they'll do is look at additional medical records and stuff and do some digging to make sure that the person really should have been issued the policy and there weren't any issues in the underwriting. So they have that 2-year grace period, the insurance company does, to make sure that if someone dies in that first 2 years, they can dispute the claim. So I hope that some of these vocabulary words helped you learn. I hope this is helping you guys. vocab's huge. This is a huge part of the exam, especially having an example that paints the picture. And I have this for every single topic that you're going to run into on your life and health insurance exam. So if you feel like a copy of the vocabulary words would really, really, really help you, click the link in the description of the video or the pinned comment. You also want to check out this next video coming up, and it's going to really, really teach you more about the different types of policies you're going to be tested on for your life and health insurance exam. Drop a comment if you have any questions, concerns, subscribe to the channel, turn on post notifications. You guys are awesome. Thank you so much.